Hi, thanks for watching another episode of Unlocking Medicare. I'm your host, Tyrone Carr. Today we're going to talk about long-term care insurance and why I think it's something of the past. Now, for some watching this video, you may have a long-term care insurance policy, and that's great. Maybe you got it at the right time years ago. And now today, it's just something that's expensive, it's old, and it may not be something that creates a lot of value when there's other resources that are out there. So I'm going to use an example of why I think long-term care insurance is something of the past. And the reason I bring this to your attention is because I have clients and people that we meet with, and it's always a topic of conversation that comes up when we're doing our Medicare presentations. And so this is what I want to share with you. So traditional long-term care policies, why do you purchase it? One, it's for nursing home, assisted living, and if for some of you that you've purchased a policy, maybe you have a home care rider built into the policy. You purchase this policy because you want to transfer the risk from your hands and put the risk on the insurance carriers in the event that something unfortunate occurs, like a stroke, a heart attack, you're diagnosed with cancer, and so you need something to offset that expensive cost for nursing home or assisted living. Now, I've got clients that spend $50-some thousand a year for nursing home assisted living, and then I've got clients that are spending over $200,000 a year for nursing home or assisted living because of the type of care and the round-the-clock care they need for their specific condition. Now, with that being said, first alternative, go and purchase a long-term care insurance policy. So what happens is you're going to pay a monthly premium. Now, I'm just using this number as an example, so don't hold me to it. So let's say you purchase a policy at $300 per month. Now, this policy, you're purchasing a benefit per day or per month annually and for a period of time. So you could purchase a policy for 2 years, 3 years, 4 years, 5 years. But in this example, we'll just say this is a 2-year policy. And it's costing you $300 per month. We times this by 12 equals $3,600 per year. Now, if we take the $3,600 times it by 30 years, you would have paid $108,000 into your long-term care policy. Now, one of the characteristics that's true to long-term care policies is typically these premiums, they're not locked in. So it's typical we'll see rate increases with your long-term care policy, sometimes every year, every few years, but they do increase over time. And that's historically speaking. So the problem that I have with it is you could pay into this policy over this period of time, whether it be 10, 20, 30 years, and if you don't use it and you pass, that money is then, it's voided. It's not passed down to a loved one. Now, in some case, maybe you have a shared policy, so that policy could be shared to, a surviving spouse. However, if you both pass, the money that you've paid into a long-term care policy is gone. It's not paid or passed down to, children, grandchildren, or any nonprofit, for example. Once you've passed, that policy is then voided, and it's no longer there. So what I'm more of a fan of is, instead of a traditional long-term care policy, is what I refer to as a hybrid. So a hybrid policy is better utilized, and I feel it's money that's better leveraged than a traditional long-term care policy. So a hybrid, and this is just a term that I use, a hybrid policy is a combination of life/long-term care insurance. So again, just like a traditional long-term care policy, you pay into that policy. So let's say you're to use that exact same dollar amount at $300 per month. Again, I'm just using examples. And let's say this is going to buy you a $250,000 long-term care / life insurance policy. So you've continued to pay into this. Now, it has two features. One, it acts as a long-term care rider or benefit, and then you have a life insurance benefit. The nice thing about this is you could pay into this policy. And if you're 5, 10 years, 15 years into the policy, and let's say you had an unfortunate accident or you're diagnosed with let's say you had a stroke or Alzheimer's or dementia, Parkinson's disease, and your need of that care for a nursing home or assisted living or home care, you can borrow from the death benefit, the $250,000. So let's say you're going to get, I need, $50,000 to pay for that assisted living facility. You can borrow from the $250,000 to pay for that cost of service that's needed to help take care of yourself or your spouse. Now, in the events that, let's say you've paid into this policy for 10, 15, 20, 30 years, or even in day one, you've paid into a month's premium and then you pass, it then pays out this to your surviving spouse, your children, your grandchildren, tax-free death benefit. So you don't feel like you're paying into a policy that otherwise you're not going to receive the benefits of it at some point in time. Now you, as the policyholder, won't unless you use it for the long-term care benefit, but you know that your loved ones, or it could be, again, a trust or a nonprofit, for example, whomever you name the beneficiaries, will receive some form of tax-free death benefit at a later time and date. So this is a better way to utilize your money or leverage your money to your advantage versus just give it to a traditional long-term care policy that you may or may not use. So if you enjoyed this episode, please click the button below, subscribe to our channel, and share it with your friends. And again, we appreciate you watching this video. Until next time, we'll talk to you soon.